How do insurance algorithms predict home claims to affect premiums? Imagine your home insurance premium as a puzzle piece that fits perfectly with your risk level. Now, think about how insurance companies use smart computer programs to figure out that risk. These programs, called algorithms, analyze tons of data to see what might happen in the future. They look at your past claims, details about your house, and even outside factors like weather or nearby crime rates. All this information helps them build a complete picture of your risk. The process starts by gathering data from many sources. Insurers collect details from previous claims, such as how often claims happen and how much they cost. They also include information about your home size, age, location, and security features. Demographics like your age and occupation can also play a role. Sometimes, they even look at weather patterns or crime statistics in your area to understand environmental risks better. Once they have all this data, they use machine learning algorithms. These are computer programs that find patterns and relationships in the data. They can detect complex links, like how a house in a flood-prone area might have a higher chance of claims related to water damage. These algorithms keep improving as they get more data, making their predictions more accurate over time. A key part of this process is turning raw data into useful information. This is called feature engineering. For example, instead of just knowing how many claims you made in the past, the model might look at how severe those claims were combined with how often they happened. This helps the model understand your claim behavior better. The algorithms are then tested with historical data to see how well they predict future claims. They estimate how often you might make a claim and how much it could cost. For home insurance, they consider risks like fire, theft, or weather damage, and sometimes even how these risks are connected. These predictions help insurers set your premium. If the model shows you have a higher chance of making a claim or your claims tend to be expensive, your premium will likely be higher. If your risk is lower, you might get a discount. The goal is to match your premium with your actual risk, making sure it's fair for both you and the insurer. When you file a claim, the algorithm updates your risk profile. If you make a claim for a big fire or storm damage, the model considers that in your next renewal. This might lead to a higher premium because your risk has increased. Conversely, if you have no claims for a long time, your premium might decrease. In this way, these smart algorithms help insurance companies be more precise. They make sure premiums reflected real risks, which keeps the system fair and stable. So, the next time you see your premium change, remember that behind the scenes, complex data analysis is working to keep things balanced for everyone.